Good morning. Credit markets, what's next? I'd like to introduce our panelists to you, starting on my far left, David Warren from Brevin Howard, Steve Tannenbaum, Golden Tree Asset Management, Mark Rowan, Apollo, Josh Friedman, Canyon, Mark Antonazio, Crescent Capital, and Richard Cantor, who's going to keep them all in line, the Chief Risk Officer, Moody's. Thank you for joining us this morning. And we're very focused on credit. We've had an amazing 3 or 4 years of improvement of credit. And I'd like to start, if I could, with you, Richard, talking a little bit about credit as of April 2014.
Well, thank you, Mike, and thanks for the invitation. Glad to be back. I'd like to start off by talking about a sector I spoke about last year and just wanted to reiterate the confidence I expressed then about the non-financial corporate sector in the United States, and thought we could turn to slide 3 to just sort of set the stage there.
Maybe before we get there, we should see, because I noticed out of the 1,000 people with us this morning that there's 2 that weren't there last year. So let's see what you did say last year.
We've had 3 major. We've had 3 major.
We might have to come back to what you said last year. So
Okay.
why don't you include last year and this year?
Okay. So on slide 3, if we could call that up, I wanted to focus this time a bit on the speculative grade sector and the investment grades separately. And first wanted to put up a chart here that showed the historical experience of the spec grade default rate in the United States and paired it alongside the high yield spread. And those 2 lines at the top of the chart move very closely together, and it's not surprising there's a close relationship there. There may even be some mutual causality there. But I want you also to focus on the red line at the lower part of the graph, which is the change in the U.S. unemployment rate. And this is, a surprisingly strong predictor, in my mind, of the high yield default rate. And notice it's the change in the unemployment rate. It's not the level of the unemployment rate. It's not that high unemployment automatically means default. It's really when the unemployment rate is increasing. And what you see here is 2 points I'd want you to take away. One is you need a pretty meaningful move in the unemployment rate to get a spike in the spec grade default rate. And I think most would agree that over the next couple of years, that's highly unlikely. So we're highly unlikely to get a spike in the spec grade default rate. The other thing I'd call your attention to is that in previous cycles, it didn't take a big move in the unemployment rate to get a pretty significant move in the spec grade default rate. A meaningful move led to a meaningful move. But when you turn to the Great Recession, you see that despite what on that chart is really an enormous move in unemployment rates, there was indeed a spike in spec grade defaults, but it was short-lived, and the cumulative default rate over the period was not that great. So there may actually be a declining sensitivity of spec grade defaults to the unemployment rate. So average unemployment default rates may be effectively falling. But let's turn now to the investment grade sector on slide 4. Here you have default rates for investment grade U.S. corporates 1 year after having an investment grade rating, or 3 years after an investment grade rating, or 5 years after an investment grade rating. And of course, the likelihood of default increases with the investment horizon, but it's very rare to have a default within 1 year. More common after 3, but after 5 years, it becomes meaningful. There are periods where you can have a 2% default rate, something you definitely need to worry about. And what you'll see in this chart, though, is that investment grade defaults were pretty serious concern in the last 2 cycles, the earlier 2 cycles, and in the 90s and around the LBO boom and the dot-com boom. But in the Great Recession, there were hardly any. I'd like to explore that a little further by turning to Chart 5. And in Chart 5, what we've done is look back at episodes of major credit transitions for investment-grade corporates. These are pretty rare, but these are the things that you, as investors, need to worry about. A credit literally falling out of bed pretty quickly. And I chose to highlight issuers that had 5 rating notch downgrades within 12 months. That's pretty dramatic. But you see that those events do occur. And you see in this chart 2 periods where there was quite a few of such events. In the earlier period, many of those events were leveraging transactions, different types of ways that firms restructured themselves, went from high-grade type firm to a high-yield type firm. And that's a risk investors need to face. There are also economic distress that causes these rapid downgrades as well. In the next phase, where we saw a surge in these types of events, more of them were driven by economic distress. And in both periods, there were some incidents of litigation and, of course, around the dot-com period, some accounting irregularities that led to these well-known transitions. But when you turn to the Great Recession, you certainly don't see accounting irregularities, you don't see litigation, and you don't see that much in the way of leveraging transactions. So the question facing us today is this another sign that the corporate sector is now a safer place to invest, that you don't have to worry as much about these rapid credit transitions, or with the wave of LBOs we're seeing in the recent weeks, are we and leveraging transactions being proposed? Are we about to move into a late cycle phase where we have to worry about this today? Actually, those mergers that we're seeing, many of them have a strong amount of equity finance in them. They're not as highly leveraged as transactions from other eras. So far, I would say we have less to be concerned with in the sector than in the past.
Now, one of the questions, Richard, I just wanted to bring up, I know we read today that now, in the last day, 25% of all the AAAs were downgraded in the industrial companies in one day. So there's only 3 left. How would you adjust when we say there's only 3 AAA companies in the United States today? Are we accurately measuring credit if that's the case?
Well, I think there's a couple things in play. I think many years ago, as you were well aware, there were a lot of corporates in the United States that operated with very low leverage and strong credit metrics, and were happy to stay that way forever, independent of whether a financial advisor said, you could improve your ROE by leveraging up a bit. We find today that there are fewer companies that want to maintain the kind of profile consistent with a AAA. It's also the case that we had some surprises, some of those I indicated to you in my previous chart, where firms that looked rock solid had rapid transitions for a variety of reasons that made us more cautious, and all people in the market, frankly, more cautious about the stability of such companies. And our criteria probably evolved over time to reflect that risk. What I've pointed out is that maybe we've reacted too strongly, in the sense that if you were trying to put on parallel credit risk today versus what it was 30 years ago, this sector could be rated a little higher. It's an open question, a matter of debate. I'm quite confident that we've got a strong rank ordering within the sector, that the ones we rate higher are stronger than the ones we rate lower. But aligning this sector with other sectors, financial institutions, public entities, structured finance securities, is a challenge, and it may be that investors may feel that the sector is a little safer than other similarly rated credits. An interesting topic to discuss.
Mark?
It's focus on default rates is one thing, but I also look at the seeds of default. So we now have an answer as to how long forever is. Because in the bottom of the crisis, people said we would never do this again. So forever is 36 months. We're back to doing exactly the same things that were done in the credit markets in the crisis. Covenants have been stripped away. Cov-Lite is the norm. Senior debt levels are actually higher than they were in 2007, although total debt is not yet quite where it was. And so I think you may be right that we are not looking at immediate defaults, but every buildup of credit, like we've seen, ultimately the bubble is pulled out of, and the question is how and when. And when I look at what's happening in the credit markets today, I think we've been through this incredible run. We've had 4 years of easy markets. And but I say easy, we've been able to go into the market and buy something that has value and feel good about what we've bought. I think by and large that phase is over. Now we're in the hard credit market where we have to go originate, find it, scratch, claw, look for complexity, look for things that are misunderstood. And I think we shouldn't underestimate what's happened from a structural point of view. In the last couple of years, we have seen the marginal buyer of credit be an open-ended mutual fund or an ETF. An open-ended mutual fund or ETF buys when they get cash and sells when they don't have cash. They don't read documents. They don't ask about covenants. They don't ask about terms. And it moves very quickly. And one could actually ask whether investors so starved for yield have gone into these daily liquidity products for products that are actually not daily liquid. Well, anyone who's ever closed a bank loan, start to finish, that's a 30-day process. I can't imagine in our business giving people daily liquidity for a 30-day process and taking the risk. So I do see many signs of the bubble, the future default specter that you're talking about. I can agree that short term we're not likely to see that, but all the danger signs are there of a future crisis. And that I think that's our job, is to step wisely and try to avoid that.
I would add one point to that, which is just on LBO. Sorry, Steve. You never hear about caps on interest rates and swaps on interest rates anymore. So you have this astronomical increase in bank debt, usually being used to pay a dividend to the sponsor. And based on LIBOR that's really low, and people say, well, interest coverage is just great. Well, take a look at it when interest rates go up 200 basis points and see if it's so great. Everyone was capping bank debt when LIBOR was 5%. They don't do it when it's a fraction of a percent.
Richard, I liked how you had the slide on unemployment, and you didn't have the slide or slide on underwriting. And I agree with that, because it's primarily the economy that causes increases in default rates. It's not underwriting. Now, you have exceptions like subprime where it was clearly the underwriting as well, but that's the key element of defaults. And it does seem as if there's a distance or a 12, 24, whatever months away from a bad economy. So I do think focusing on that is correct.
I think Mark brought up an interesting point for the panel, and that is institutional memory. And an area that we've discussed over the years of sovereign debt. When at the extreme you have the head of the Federal Reserve telling you no one ever lost money, loaning money to a country. And so the cycle, Argentina would not be able to borrow at the $100 billion level if anyone had an institutional memory, and that they've defaulted 7 times. And so the fact that in late 08 or early 09, Mark, that PIK holdcos, the average price on a PIK holdco was 25 cents on the dollar. That was the average, and people went to church and promised they would never buy a PIK holdco again. Well, we see that more PIK holdcos were issued in 2013 than any other year. And this creates opportunity, but the opportunity might be a few years down the road from that. And I think the point that Josh was making, if I ask this panel, how much influence, here we have 5 of the major buyers of debt in the world, how much influence do you have on public or private placements today, not mezzanine, on covenants when you want to buy? Let's start with you, Mark. How much influence does your firm have?
On publics, very, very little.
Do you have any?
Not on publics.
Okay.
No, 0.
Same.
95% of the time, 0.
Hey, David?
Yeah, in privates, yes. In publics, difficult.
Okay, so what we're seeing here is that here we have 5 of the major investors, the most successful investors in the world in credit. But today the market has expanded to such a degree that you cannot negotiate credit terms that you might have been able to negotiate at another period of time. And the fact that I think that Josh has touched on, that you can't even require caps. And therefore, the full movement of interest rates, generally above the 1% level, will result in interest rate increases for the company if they don't choose to do that. I'd like, if we could, Steve, kind of talk a little bit about some of the issues that you've brought up, and particularly credit spreads today. Now, when we look back over time, let's go back to 2008. We're now just kind of getting ready for the depths of the credit markets, which occur later that year. And let's see how much younger you look.
The pre-crisis photo.
Yes, a pre-crisis photo.
Take a look at that video of Steve Tannenbaum in 2008.
Ooh.
We think that bank debt's a better value, but on bonds, we feel that you're going to get much better entry points, and that's a function of the bad numbers. You still haven't had the bad numbers yet on a year-over-year basis. You're just getting them now. And as you get further through the cycle, and it looks like some of these capital structures don't make sense, you're going to get better entry points.
Okay, so at that point in time where we're getting ready for one of the 2 greatest opportunities to buy in the last 50 or 60 years, the other being 1974. Steve, take us to today, and what are your views today?
So in 2008, it was a matter of just going to the party. If you showed up to the party and you started, even, called in mid-08, even before Lehman, it was a good entry point to start. Now it's which party you go to. You just can't show up to the party. And to put things in perspective, you start with what we expect in terms of what your gross spread is. In the case of high-yield bonds, of called almost 370 basis points, and then what your expected loss. And from here, you look at default rates, and historically since 1980, default rates, if you turn to slide 9, is around about called 4.5%. But after you've had several years of low default rates, your historical default rates go up because you're just closer to the end of the cycle. So we think probably 5% plus is a good estimate of where we expect default rates to be. And historically, you've had a severity of around 70%. Now, I would challenge Richard that I don't think the underwriting standard is any better today than yesterday, and certainly the last 30 or 40 years. So we expect that loss ratio to be a pretty good estimate of what we expect. So when you take your gross spread of 370, you take your default rate of 5% and 70% loss, you get not a lot of spread when you're in high yield. So that's a party we're not anxious to go to. Contrast that with other places in the credit market, such as leveraged loans, which I do agree that this idea of using it as a money market fund, which I believe is how it's being used by a significant percentage of the investors, is the wrong use. But but you are getting a better, I guess, net spread after expected loss in loans. When we look at different parts of the market like asset backs, whether it's student loans or AAAs, we think that when you take your risk, and in the case of AAA CLOs, we think it's relatively low risk, and the fact that you're getting spreads that are historically very wide, we think that's a much better party to go to. The same with student loans.
Can I make a comment on the bank debt issue?
Sure.
We had a rather ugly experience owning a lot of very high-quality first lien bank debt in 2008, pretty much all of which went from 90 to 65 to par. Looks great over 2 years. Nice place to live. Not so good over the 1 year. We've had 95 weeks in a row of inflows into these money market type bank debt funds because everyone wants to take advantage of the potential for rates to go up. Meanwhile, of course, 10-year, 30-year Treasury has been the best asset class this year, but let's put that aside. So 95 weeks in a row of inflows, 1 week of outflows. Meanwhile, investment banks have gone from putting up, call it $250 billion to maybe a fifth of that in terms of their capital devoted to market making. What's it going to look like when we get 5 weeks of outflows or 10 weeks of outflows? Even if the recoveries are better relative to the compensation for that than high yield, I would argue that unless you have a locked up vehicle, par leverage loans just aren't very interesting right now.
There's a still
Steve, I think let's just expound on this for a moment.
Sure.
Expand if we could. I think for the audience, we should focus on, let's talk about the difference between a CLO, maybe a cash flow CLO, and some of these open market bank funds that Mark has addressed. One that has a permanent life with a fixed structure, and those that are in the open market at this time.
It's a great point to expand upon. CLOs are locked up vehicles. Their assets are loans, their liabilities are debt, and they're somewhat rule-based. And so if the price drops materially, as what Josh was saying, they're not forced sellers. It's more if their ratings drop a certain percentage. If half of the loans drop to CCC, yes, they would have to unwind, but that didn't happen the last time, and there's a healthy margin of safety based on prior cycles. So those tend to be relatively stable vehicles, and I would argue that there's probably at 90 cents or so, which is not a good return based on today's average price of 99 and change, but a pretty healthy CLO arbitrage, which would, I believe, come into the market. But contrast that with the daily liquidity funds, which, as Josh was saying, there's 30 days to settle, and you have daily liquidity, and there's a mismatch.
I always say, I joke sometimes that in my next life I'm coming back and I'm going to trade opposite an open-ended mutual fund. I may only work 12 days a year, but those are going to be 12 perfect days. I think what I would try and do is maybe elevate the conversation. I think CLO is a better way to own it than an open-end mutual fund. Our firms collectively have gotten to such a scale that I think one of the interesting things is to try and build businesses, build capabilities that do not subject us to competing with open-ended mutual funds and ETFs when we don't want to compete with open-ended mutual funds and ETFs. It is in part locked up capital in CLOs, but it is in part, I think, taking some of the human talent that's been leaving the banking system, repotting them with new capital bases within our firms, and whether it's direct origination or some of the specialty lending businesses in oil and gas, in shipping, in mining. I do think that having both franchises, the so-called easy business, which we source from the market, and the hard business, which we go out and originate, allows us to avoid the kind of markets that we don't like. Now, you can never fully avoid them because you're subject in both markets to some notion of market pricing. But this year for us has been a focus on avoiding anything with a CUSIP that's tradable that can be bought by a non-credit sensitive credit buyer, and trying to do everything else, whether it's a structured product like RMBS or it's a directly originated loan. It just seems that we've been given this somewhat gift of regulatory change, which has pushed so many of these markets open to us for the first time, that in many ways that's the most dynamic thing, certainly about our business today, and I know some of your businesses
Mark,
as well.
I want to use that to turn over here to David Warren. When we talk about markets, and I think one of the things we are very concerned about you appreciating is that we believe there's more than $30 trillion in liquidity in the world. So part of what you're hearing from the panel is being driven by this enormous liquidity that exists in the world. But the question is, how large are different markets? Obviously, the U.S. Treasury market is a significant market. The buildup in cash and liquidity in corporations is part of that worldwide liquidity, not just here, but in Japan or other places of the world today. We have trillions and trillions of dollars sitting in corporations, and in many countries, it's very large relative to the size of that country's economy. But after Treasuries, the next largest market is really the housing market. And David, this was an area I know that you were very focused on in the past, and I thought we ought to go back to 2011 and maybe take a look at your comments in 2011 at that point in time. David.
The years like 1975, the years like 2009, they're truly exceptional. They're not necessarily once in a lifetime, as you found out, but they're pretty rare. And most years, and 2011 is a year, it's not like 1975, it's not like 2009. But I want to make the point that the credit market opportunities that we see today are still excellent. This is not the ninth inning for credit. This is not the time to sell all your credit investments. This is a time to be careful about long short and not just being beta long.
Okay, so Dave, you were 100% right, and I'm sure all your investors were happy. Let's take a look at 2013 on lending.
This is a really key point. And Mike, one of the things you do at this global conference, I've been blessed to come here for many years now, is you don't just bring in market participants, but you bring in regulators, you bring in policymakers. I'm going to look right in the camera in case anyone's looking at home. Securitization works. Securitization did work. I mean, the alternative to doing all of this yellow and black and pink is the bank system, the blue, does all the lending. And then you have too big to fail in a massive way. For mortgage-backed securities, it's exactly the same thing. We don't have a banking system that can handle all of the lending, whether it's to the high-yield companies, whether it's to the person who wants a new mortgage loan. We have to have a distributed means of securitization. So I would say, again, to regulators, to policymakers, let's keep securitization markets alive. Yes, okay, Rich, you can close your ears for a second. There were some rating issues. There were a couple of rating issues last time. But we can get it right this time. And the alternative is too big to fail banks.
So those rating issues that David was talking about were the 16,500 securities rated AAA, in this case by Standard & Poor's, in the mortgage area. David?
Well, Mike, what I would say is I have a new goal in life, and that goal is to come back here to the Milken Conference 2024. And you cannot play the tape of what I'm about to say until 2024. And I think this may surprise some investors because we're starting at relatively low yields. I understand that. But I really believe that the next decade is going to be the golden era for credit investors. And the reason I say that, and Mark alluded to a few of these things a moment ago, is because of Dodd-Frank, because of Basel capital regs, because of pay limitations, leverage limitations. These are all leading to reduced banking sector balance sheets. Meanwhile, the world's balance sheet is the same. The world's balance sheet, frankly, is growing, and there's many new countries that need access to the world's balance sheet. Banks are going to continue to play important roles, but it's really investors who have the direct opportunity, really in some cases for the first time, to participate in origination, to participate in complex, high-return credit and lending opportunities that used to be originated by the banks, held within the banks, occasionally distributed, often just held. And I think some of the focus of firms like ours, like others that are up on the dais, are we want to locate those returns for you and manage money. And it's really going to be a great chance to do that because the world needs the capital.
I think an important element here that points you've made, David, is just what has occurred in the United States has really not occurred in any other part of the world, maybe a little bit in the UK. But we're going to look at those markets in a moment. Mark Antonazu, what is different in your business today than it was a few years ago? The pension fund consultants and others coming to visit you in today's markets, how are you interacting with them different than you might have a year or 2 years ago?
Well, and certainly relative to 3 and 4 years ago, there's been a pronounced shift in pressure on us to deploy capital. So in the aftermath of the fiscal crisis, frankly, we had consultants and funds that wanted to give us money to deploy, but they really pressed us to be deliberate in that. They were still nervous about credit, they were very worried about liquidity, and frankly, they were worried about their own balance sheets and the ability to meet capital calls at that time. Now, every board we present in a finals at, they want to know how quickly we can invest the money. And I think one of the challenges we all have, relative to what Mark is alluding to. These new businesses are very exciting where you can make direct investments, structure covenants, drive yield. In fact, over half of our firm's assets are in those types of investments. However, when you need to deploy capital within a quarter or less, and you have a high yield market, which this year, despite everybody's concerns here, looks like it's going to return between 6 and 7%, and that meets a lot of clients' targets, you have to take advantage of that. We had a transaction last week, Numericable, that was, it said, over $100 billion of orders. 100 billion. I mean, Mike, imagine if we took $100 billion of orders.
And let people know how large the issue is.
21 billion if you include some of the holding company paper. So 5 times oversubscribed, worldwide demand, 700 institutions buying, and bonds that traded up 3 points. Well, there's nothing bad about bonds that trade up 3 points on the break, right? So we feel like we have to participate in that too.
Let's take a look at Mark talking about one of his favorite subjects, the U-shaped recovery.
In 2008, 2009, everybody talked about a U-shape or bathtub-shaped recovery, and then when it came, everybody said, boy, this recovery is so slow, and it's everything we predicted. Corporate managers are much more disciplined now. We're seeing, if we look at our private portfolio of companies, capital spending on average is down. So deals that we're funding now, companies have lower CapEx. Companies are slower to hire. They're much more disciplined as we come out of the recession in bringing workers back or finding more efficient ways to do things. So I think, and I believe companies, although maybe not to the investment grade, Apple, Microsoft levels, but even high yield companies are husbanding their cash more.
So Mark, how is that U-shaped recovery? Are we still going up on the U? Or?
Well, I think we're still kind of in the bottom part of the U. We still have low growth, although it's steady. We still have low interest rates. And, at the same time, we have high corporate cash, as you're pointing out, high M&A activity. The financial markets, there's been a dramatic shift coming out of the fiscal crisis. Up to 3/4 of our financings were for refinancings. Now, and obviously the statistics are skewed by the recent larger transactions, but over half the financings today are for M&A activity. Very, very different paradigm. So, I think that with that and low defaults continued, at least for this year, I would agree it's a good time for making credit investments.
So we've now adopted a couple things here. One is the new normal that was presented by Mohammed about 10 years ago or 8 years ago at the Global, and now the U-shaped recovery by Mark Antanasio. Josh, a lot of your work for many years was really in loaning money to industrial companies focused on credit, LBOs, different structures. But back a few years ago, you told us about the value in housing. Let's take a look at Josh from a few years ago, 2011.
You might start with a portfolio where 5% of the loans were people who had complete credit files, whose house might have been a little too large to qualify for an agency pool, so it ends up in a non-agency pool, and who now have gone 5 years and have never missed a payment. In the beginning of the portfolio, you couldn't identify who that 5% were. But that 5% might be 20 or 25% of the portfolio today, simply because 3/4 of the portfolio has defaulted, been foreclosed on, and whatever recoveries existed. So the profile of the remaining homes that are still in these Alt-A structures, where the foreclosure hasn't taken place yet, is far better than the portfolio appeared to be a year prior.
So both you and David really focused on this, Josh, but this was a phenomenal investment opportunity that you and your firm had identified. By 2013, people thought, well, maybe that appreciation had taken the future value out. Let's take a look at you last year.
If you use current assumptions about the housing market and have just a little bit of reality as to the extent of improvement that's taken place, and these are still homes that trade well below replacement cost, You can pro forma rates of return that are well above CCC rates, and that's after adjusting for losses. So if CCCs are yielding 7% and high yield generally is yielding about 5% before losses, and here you have assets that are yielding more like 10 after losses, to me, when there's a little more visibility, you'll get a significant yield compression, and that's how you get to 20%.
So Josh, a year later, how did that investment thesis work out?
It's pretty much what happened, and I appreciate you putting up something where we actually got it right. Those securities were up in the mid to high 20s last year, and it has been an issue of yield compression. And they've continued to do well this year. This has been the gift that keeps giving longer than we ever expected. Part of it, I think, was good credit selection. Part of it is that the goalposts keep getting moved because housing prices are up and fewer people are underwater in their houses. And I talked about the 5% of those portfolios that consisted of people who, from the very first day, haven't missed a payment. If you look today, over 60% of the borrowers in our RMBS portfolio are people who have plenty of equity in their homes and are no longer missing any payments. And we own security. We compared this to CCC, but our securities are senior. The CCC bonds we're comparing it to are junior. But our CCC senior securities have an average dollar price in the 60s today. So they're covered by that part of the portfolio alone. And you still have a combination of a yield compression opportunity as traditional lenders start looking at these as essentially almost investment grade portfolios with shrinking durations. So that produces one more leg in that market.
Yeah, I mean, investors often ask me, I'm sure, Josh, you get these same questions. We hear of multi-strategy funds that have sold now all of their mortgage-backed securities. How could there be anything left? Well, the beta trade, the 2012, 2013 beta trade is largely over. But I think of 5 areas where we still have investments in structured finance securities that we think are going to produce much higher returns than CCC corporate bonds. Credit sensitive, we own MBS at 10 cents on the dollar, at 60 cents on the dollar. They may not return par, but they're going to return a lot more than the price we paid for them. Monoline insurance companies still playing out that default risk. Put back litigation, reps and warranties still has legs to play. Non-property asset-backed securities, student loans, aviation finance, there's other interesting niches where one can play. And increasingly commercial mortgage-backed securities where the default cycle is actually ongoing. Given the 10-year loans that were created in 06 and 07, they've not been fully resolved. So sadly, for investors, there's no cheap way to play this. You can't buy an ETF that gives you access to these markets. You kind of have to hire a professional that really does this full time.
I'm going to echo what
one comment of David's there. I think that beta trade, I think a lot of hedge funds that were multi-strategy funds did exactly what you said. And I think it was a very astute move by them. I don't think it's, I wouldn't criticize them. I'd say that part of their job as multi-strategy allocators without a fixed mandate, who have the flexibility, is to find cheap asset classes. But that's different from selecting the individual securities, which is how you get the trade to last an extra maybe 3 years.
That deep fundamental homework.
So, in terms of just knowing which party to go to, you look at in the paper, you see that JP Morgan settles on the mortgage securities. The biggest beneficiary are the monolines. And you don't hear it, but they're the people who are insuring. And so they get stronger. And if you look at where the monolines, whether it's wrap bonds, in Puerto Rico, for instance, you can get 55 cents on the dollar wrap bonds of MBIA and AMBAC, which are terrific value. You can get CDS on MBIA, which really didn't move that much after they got a material equity injection from the U.S. government. So I think that there's a lot of different themes here.
And we bought the AMBAC insured bonds on the default date at 20 cents on the dollar. Almost certainly going to pay par.
Let me try it from a slightly different perspective for you guys.
Mark.
So we've had a multi-year massive RMBS position, which has been great. And one of the things that I think we're sometimes not appreciative of is the different types of investors. So in a hedge fund, you buy what you want to buy, and in our hedge funds and your hedge funds, you buy what you want to buy. But if you're a regulated entity and you need investment-grade securities, the piece that people are missing on these RMBS securities is they're now re-rated investment-grade by PIMCO, which in and of itself is an interesting phenomenon. But when you look at what an investment-grade buyer can buy on a yield basis, I would much rather be in the RMBS security, the super senior part in the 5s, than in a corporate investment grade bond in the 3s. The thing that I think we have to appreciate before we get too excited is every day the market gets smaller. And so as we think about how we're going to drive our businesses going forward, and as we think about our clients looking for yield, if we're only a buyer of that which is shrinking in supply, our business is going to shrink and the opportunity set for our clients is going to shrink. Part of what we've tried to do in every business, corporate and now in real estate, is to be in the origination business. So like the corporate business, we have now pushed into origination and looked at the part of the markets that are not dominated by the government, which are things that are non-qualifying and jumbo, where we are now creating returns that are consistent with the super senior RMBS with newly issued. So I want both sides of the market again.
Let's take a look, Mark, at this concept of an expanding market. And I think what you're hearing, if I'm to summarize, from all 5 of our panelists is they are focused on origination, they're focused on mezzanine, they're focused on structure today. And I think one of the things that Mark has brought up here is in some of these markets, the market is shrinking. Non-outstanding is shrinking. Let's take a look, Mark, at your discussions on the expanding marketplace rather than the shrinking marketplace.
I don't think the investment marketplace is limited. I actually think from an investor's point of view, the investment marketplace is expanding because that which has been off limits, financial institutions, is so big and is shrinking so fast that I think if they adapt, I think you're going to see a whole slew of new and different investment opportunities that come to investors with patient capital.
So let's take a look at an opportunity. You're the 2nd largest economy in the world. At some point, you will be the largest economy in the world, most probably. You don't really have a high-yield market. You don't really have a debt market, really, of any depth. You have some of the challenges that Japan had in the mid-'80s, where a handful of large banks really dominated the financial marketplace. There wasn't a lot of competition, and there wasn't any real independent pricing of loans. And if we took, for example, a look at slide 33, we could take a look at that market today, China. And so as we look at the opportunities for small and medium companies in that area, you have an enormous opportunity to try to create a market and build a market from this standpoint. This is a look here at some other countries where you look at the assets of the 4 largest banks as a percentage of the GDP. And so there is an opportunity, as we are well aware of, these financial institutions could not be liquefied for many reasons. Number one, they're unrealized losses. So now with the market improving to such an extent, you can see here that there is an opportunity. And so based on the Ireland experience, where the country was quite responsible, it's just that their 3 or 4 largest banks took losses equal to the entire GDP of the country. Today, the 3 largest banks in France, and as we saw in that chart, other countries around the world, their banks are very large relative to the size of their economy. And so with the 3 largest banks in France, similar in size to the 3 largest banks in the United States, even though the U.S. economy is 7 times as large, one of the great opportunities would appear to be in Europe, and also to strengthen the financial system by helping to shrink many of these financial institutions and create secondary markets. In terms of Europe, would anyone like to discuss, Josh, the opportunities in Europe versus maybe the United States today?
Sure. U.S. bank debt is probably held 30% by banks at the most. So if there's a problem credit, you can rest assured that one of those other 70% of the holders is a hedge fund, a CLO, whatever. It's broadly distributed. In the U.S., there's high-yield bonds outstanding in most of these credits. So generally, if there's a credit problem, there's a lot of information that's already in the market, and you're competing with dozens and dozens and dozens of players to try to buy things at the right price. In Europe, there are either bilateral loans or there are multilateral loans. There are maybe 5 lenders. Many of the banks have now taken their problem credits, moved them off into liquidating entities like Sareb or like the NAMA or some of these other entities. Many of the banks have now recapitalized, Lloyds, Barclays, and others, so they can finally afford to sell their problems. And when they sell something, they're not credits that have been well distributed in the market.
This slide up that we just showed you is really related to issuance, not related to amount outstanding.
So you've got a couple of $100 billion at least of paper that's going to be sold. You know with 100% assurance it will be sold. It's on someone's sale list. There's a process. It's competitive. You compete against other sophisticated people, almost all alternatives people, like some of the people on this panel. The nice thing is that all of the competitors are people who have double-digit returns in mind. The sellers are not, they're price sensitive, but they're more process sensitive, I think, than price sensitive. They want to go through a certain process. And they're large, so $50 to $500 million blocks. So that takes the competition level down to a place where at least you have a credible shot at having very good value, which I think stands out in significant contrast to most other credit markets that we participate in today. And as Mark Rome was saying, structure of your capital is absolutely critical. You know, so far the daily liquidity guys have not shown up in this market at all. And I hope they don't.
I think we're going to be working in the European NPL business for a decade. I think there's a lot to do here. And the thing I think we've all discovered, buying a European NPL is easy. Collecting it is the hard part. And so if you're going to be in this business and you're going to make a major push into this business, you need an infrastructure that says you're going to be there for a decade with it. Total professional employment at Apollo today is kind of 250 people, 600 overall. There are 600 people who work in our servicing business in Europe collecting NPLs, whether it's credit card NPLs, shipping NPLs, real estate NPLs, other types of consumer NPLs. And while it has gotten more competitive, I think we're going to be doing this for a very, very long time. I also want to call attention to the other side of the opportunity. I think it's very hard for these institutions, the banks in Europe, to play offense and defense at the same time. I think most people, and I believe they're going to shrink. They're dealing with NPL issues. They're dealing with right-sizing their balance sheet. I think there's a really interesting opportunity that has not yet really bit in origination. I think European origination, stepping in where banks are reluctant to provide credit, will also be a good long-term opportunity, but certainly behind where we are in the U.S. from development of competing origination franchises.
I think following up on that point you've made, Mark, here, if we looked at Southern Europe, Italy, Greece, Spain, during the difficult periods of time, as Mark said, when you're trying to collect, you've stopped lending. And many of these companies created tremendous opportunities to loan them money that were good credits. They might have been international companies, or their major operations might have even been in the United States, but they were headquartered in Greece or Italy or Spain at that particular time. Steve, did you want to weigh in on this subject?
Sure. If you go to slide 12, we see this as, they clearly need to shrink. What's interesting is they're in the process of shrinking now, but you also, the ECB came out with a paper, and you'd never see this out of our Fed, which basically said, you know what, securitization's a good thing. This was a couple weeks ago, and basically took odds with the regulators, with the about to encourage securitization. So we do feel that the securitization market's going to actually get a boost here, and that there's going to be a material push to transfer the assets to the securitization market, and that's going to be a key way to delever. In terms of just the product, by far the most interesting, I guess, on situations that we're looking at are from European banks. And I'm going to say, it's, and my guess is it's probably similar for everyone on this row, that it's in the billions of opportunities as a snapshot today, which is, a pretty healthy amount of product.
Mike, I'd like to just add onto what Mark's saying. I think there's a sourcing opportunity right now in Europe. We're seeing, and not just in countries like Greece and Italy, but UK, France, Netherlands, Companies need capital. Good companies, low leverage multiples, double-digit kind of returns like we like to look for. Yeah, you've got to have people there to source them, but there's a lot of opportunities right now. I don't think we have to wait for them.
Richard, how are you looking at Europe today, juxtaposed the United States at your firm?
Well, having achieved some stability in the macroeconomies and lowering of borrowing costs for the sovereigns that gets passed on to the banking sector, provides a much firmer ground for all sorts of capital market development. We're following the discussions around the encouragement of securitization in Europe quite closely. We think, we agree that securitization in Europe performed well through the crisis, generally speaking, particularly SME securitization. But there isn't at present an infrastructure in place to harmonize the reporting, data reporting that the European regulators are looking for to push through a large volume of securitization that will be easily understood by the market. So they have a number of challenges ahead to expand the market to the degree they would like to do.
I think, Mike, one other thing I wanted to add is the ECB seems to be flirting with easing policy, and that's going to inflate assets. And they keep to say we are, we're not, but I believe that they're going to continue to ease money, reduce the cost of capital with the sole purpose of inflating assets to help the banks get out of this and encourage lending and improve their economy.
And they have a challenge to do it with sovereign debt, so they may have to go to the ABS market or create a new ABS market. And it's back to the points I've made in the past. Securitization works. Bank balance sheets are too large. It's investor capital, your capital, that is going to be needed to fund these companies and to fund these assets.
And it's going to be a virtuous circle through QE that, whether they're calling it QE or not, it's going to be in effect QE.
I think we should not forget, since this conversation is taking place in the United States of America, that there was a treasurer of a credit many years ago, more than 200 years ago, who was told at that time by the European that he was the worst credit in the entire world. And his debt was trading at less than 20 cents on the dollar. And like many others in the role that he was playing, most of them chose just to default. And one of the points that you've just made, I think is very important from this standpoint, David, is that he decided not to default, but the way he decided was to give land, encourage growth of private individuals. And this individual, this treasurer, was a man named Alexander Hamilton. And the growth of the United States and the success of the growing businesses and operations and job creation, et cetera, and expansion eventually had that debt back to 100 cents on the dollar. And I think this is really an important point, and maybe a jumping off point, which I'd like to have for the panel. And that is, each of you could ask yourself, why did you go into finance? Those of you in the audience that are involved as investors, or in the area of people that are responsible for funds such as pension, university endowments, why are you in this area? And we've raised many issues at our global conferences. One, excess investment in personal housing, residential housing, and altering over time the utility curve of the middle class from that standpoint. But one of the things that I think we were discussing here is, how do you help countries grow? In effect, if you had created these markets in Ireland where others had held the debt instead of the banks, whether it was in loans, as Josh has suggested, where maybe only 20% were held, those risks would have been essentially judged by the marketplace. Many of those loans wouldn't have been made. But you would have never put pressure on the country. And when we look at the enormous growth rate in the United States of job creation between 1970 and 2000, if we just took a look at the last quarter of the 20th century, you can see that 62 million jobs were created. And so finding a way to get capital into the hands of entrepreneurs in Europe or other places around the world is essential for the growth, not just shrinking the balance sheets of the banks, but reducing the dependence of those countries on a few financial institutions. We should never forget that the Asian crisis of '98 started in Thailand, which was really 5 banks that financed. So when they were in trouble, the country was in trouble. So let's talk a little bit about the middle market and maybe things that you're taking and actions you're taking to try to figure out how you're going to address that middle market, both in the United States and maybe in Europe and other countries. Mark?
I'll deviate a little bit first, and then I'm sure you'll rein me in. But your remarks really remind me of an experience we're having. Each of these firms, I think, have been very successful. We all know each other. The firms have gotten very large. And one of the questions we're getting back is, when will you ultimately be regulated? And the more I go to Washington or spend time with the ECB, I make exactly the point you've made. If you put up a chart of employment and GDP, it's fundamentally linked to the availability of financing. And in the US, there seems to have been a pretty clear decision. The decision has been to remove the risk-taking activity from the big money center banks, the government guarantee, and to allow that to be dispersed to the marketplace. I will say that is not without hesitancy, because as a number of firms get bigger and bigger and bigger, I have no doubt that we will become of regulatory interest. Having said that, I think the choice is a fundamental choice. We're not a bank. We're an advisor to people who provide capital. The government doesn't guarantee us. We don't borrow from the government, so on and so on. In Europe, I don't think we should underestimate the hostility currently toward sources of private capital and the displacement of banks. It's not to say our businesses will not grow. I think all of our businesses are growing because the depth of the problem is so severe. But I don't see an Alexander Hamilton on the horizon, to be frank. And I think we're going to struggle through in Europe as banks try to hold on to their market share and their clients. And my own bet is we end up in a much more cooperative model with the banking system.
As long as we're doing financial history, I think a very hot topic here in the United States is what we do with the GSEs, with the Fannie Mae's and the Freddie Macs. It's probably useful to go back and say, why were these developed in the first place? And the reality is we had migration of people from the Northeast, where I currently live, to places like California, where we are now, and the West. And we had interstate banking laws that prevented the capital from moving. And so the GSEs were created so that the people in the Northeast in this country, the banks there, could lend for housing formation in the US. And I think some of the same issues are happening in Europe and are happening in Asia, which is how do we create entities so that we can safely invest our capital in the Indonesias, in the Chinas, in some of the other emerging markets. And certainly credit has exploded in some of those markets. This is excellent for the world over the last 5 years, but it's something that we're definitely spending a lot of time on. Is how do we safely do that in a way that doesn't turn into what the GSEs turned into in America?
Mike, I guess when you ask why we all went into finance, you can blame yourself with respect to half the panelists here. But to go to Mark's point, I think there's a role for alternative institutions to work hand in glove with banks. We run an unleveraged operation. There are certainly parts of our institutions that are leveraged. For example, the CLO business, but those leverage levels don't take public depositors' money, number one, and number two, those leverage levels are tiny compared to the levels of leverage in commercial banks, even now that they've deleveraged. You've gone from 60 times to 20 times at some of these banks, and you think of them as unleveraged. So there's a role today. You have the Volcker rule, which completely changes the way banks interact with us on the trading side. And to me, there is the issue of regulation. On the other hand, we're already generally pretty regulated. I don't know, can't speak for everybody on the panel, but most of us are registered investment advisors. We have a whole web of regulations and reporting and other things that we already do, and they don't tie our hands in such a bad way. We've still got a pretty liberal mandate, a pretty open mandate, much more open than some of these other institutions, such as loan-only funds or such as commercial banks. So to me, there's a role that's a much more cooperative role that we can have as opposed to competing with the banks every day. And it's very productive. As the banks have backed away from trading, they've backed away from certain types of origination, and they've backed away from holding certain types of troubled assets. It's a much healthier financial system, I believe.
I think
I just want to say, I think there's an area in which the U.S.-style capital markets has not really delivered the kind of growth support that the world has been looking for, and that's in infrastructure globally. The history of the bond market supporting infrastructure is a complicated one. History of the United States post-Hamilton was canal finance, railroad finance, and then other urban-centered growth infrastructure, which did support, but of course had waves of defaults and financial crises that followed each of those series. And then you look at other countries, how have they been able to finance it? You look at the growth model of China, which is basically tremendous public sector financing. Where are the capital markets? Well, these are long-term investments. They're complex investments. They take place, and there's a lot of private sector support and a lot of success. And actually, the default experience on public infrastructure investment is very low. But I think we have to recognize that the situation has gotten, in fact, a bit worse. In Europe, Dexia was a key player, and other European banks, and with their unraveling, is gone. MBI and AMBAC helped finance some of the long-term positioning of the debt through their wraps, and they're no longer active in that market. So I think there's a big gap around infrastructure. You'll see lots of reports put out by government agencies about the need to jumpstart infrastructure investment, but I haven't really heard much of an offer up from our institutions.
I'd like to just kind of push this point. One of the points that Mark has brought up here is, in order to effectuate something, you ultimately need government support. And in the mid-'80s, 85, 86 particularly, spent a great deal of time in Japan trying to convince them to create bond markets, public market pricing. And the largest resistance did not come from the government. It really came from the existing 10 to 12 largest banks, who had pretty much 100% market share and were really the financiers of the country. And at the end of the day, we told them we felt that they would rue the day that they didn't have liquidity in the marketplace. And I think one of the areas that I'm challenging you in the audience today and the panel is that there are significant opportunities here for positive social change by creating incentives. There's significant opportunities for job creation. And one of the big challenges for the world, and it's not just the responsibility of the Chinese government, but for the talent on this panel and with us, is what can we do to help the world's second largest economy grow and mature into modern financial markets. If we take a look at slide 83, I think it's fair to say there's probably as many entrepreneurs in China as there are in the United States, or maybe there's 3 or 4 times as many. And you can see here, no different than the United States, 99% of their enterprises would be small or medium in China, and all would be, in terms, non-investment grade today. A very large percentage of their GDP, the majority of their employees, but their access to capital doesn't really exist significantly, since the banks, like other countries around the world, are primarily lending to the large government-related type businesses. And what caused me to enter the financial markets and kind of change my own career from being an astronaut to working here was really the Watts riots here in Los Angeles, and the idea that access to capital was the same as many of the other issues of civil rights that were being addressed, and where you could go to school or go to eat, or whether you could even ride in a bus. And I think these are the challenges. So when we say, what are the opportunities? There's numerous opportunities, and the mistakes that have been made, particularly in recent years in the housing market, don't have to be repeated in other countries in the world. And the understanding of access to capital and the skill of our panelists here to help these markets grow in cooperation, I think, is a key. You know, there was many famous Greek philosophers who pointed out, if you don't take an interest in government, that doesn't mean government is not going to take an interest in you. And so I think this is an issue. Let's talk for a moment on, and maybe concluding here in 1 minute by each of the panelists, is how do you think your firm will change? And so, David, we're going to start with you. We're not going to go out 10 years, but 5 years from now, how do you see your business changing? What do you think the firm will, your area and credit at Brevin Howard will look like versus today?
Yeah, I think we'll continue to run pooled investment vehicles, and that will be a primary form of our capital. I think you'll see many more what I would call one-off, people like to use the phrase co-investment opportunities, where investors are presented with an individual situation to put some capital to work for a few years. I think those will become an increasing part of what we do, what the industry does, and I think that will present challenges for investors because some of you are set up to invest that way and some of you aren't. And I think, as Mark and others have said, we'll be more involved in the direct creation of credit and opportunities. Whether that's we have the hundreds of people that Apollo does, don't know, but certainly more involved in origination of credit opportunities.
We've always believed that if we don't outperform for our clients, we're not going to have a business. So that's our initial premise. You know, one of the themes here is that through being less liquid, you're going to be disproportionately awarded with opportunity and credit. So I think that's going to be a theme in terms of longer lockups, in terms of less liquid but higher return. So we see ourselves probably focusing more on some of those themes in terms of getting more locked up money and in private equity structure to take advantage so that there's no mismatch in terms of maybe the less liquid opportunities that we're seeing. And continue to stay on credit. But credit's such a wide area. We never thought we'd be involved in private student loans or looking at Russia. You know, so continuing to look at opportunities and be, you know, have our playbook. If our playbook is 20 themes now in credit, it might be 40 themes in 5 years.
Mark?
You know, I'll start where Steve started. Our business is built on value. Value is the only strategy that we execute, and value manifests itself differently in each market. But if you take a snapshot, we're round numbers 160 billion today, 50 billion of equity and 110 billion of credit. Equity will be larger, but I believe credit will be multiples of where it is today. And it will be in funds, it will be in special purpose vehicles, but increasingly it will be in permanent capital vehicles that will stand side by side with the banking system or the real estate market, and I think have the potential to be very large if we're right about where the regulatory pendulum is ultimately going to land.
Josh?
I think we'll continue to be an opportunistic, value-oriented enterprise with a variety of different types of vehicles that address different liquidity needs of different markets. I think you have to be a learning organization because we're basically in a high-fee, low-entry barrier business, although you could argue the entry barriers are a lot higher than they used to be, which means we better be doing something different, and we better be doing it well, and we better constantly be pushing the edges of what we do well, and do it carefully, not stray into areas that we don't know, but be careful about them. And whether that means that there's a higher degree of internationalization, I think there right now is a lot of pressure in countries outside the U.S. to adopt the kind of rule of law and governance that we have in the U.S., because that is what facilitates the development of those credit markets, and I think we'll follow those markets that do that in a big way. I think we'll also have a chance to have a resurgence in the U.S. Distressed market at some point within the next 5 years, maybe the back half of that, because you just don't have all this issuance at these multiples without that happening at some point. And from there, we'll just have to see what the right vehicles are for our clients.
Thank you.
Like everyone else, focus on value. A lot of value created by direct and originating investments. Anything we can do better than the public markets, we want to try to do. Focus on where there's a need. We talk about infrastructure. I think there's still a need for infrastructure investments in the United States, so we'll probably focus on that. And finally, trying to blur some of the lines and have more multi-strategy products between different delineations of credit investments. When you get down to a lot of this, you're making a loan to a company, period. And that's what we're going to try to do, whether it's a mezzanine loan, a direct loan, a public high-yield bond, a private loan. If we can do that in one pool of capital rather than several, that's what we'll try to do.
But Mark, also with a little equity kickers mixed in. Right?
Especially when we can get those equity kickers.
Yeah.
I think we learned that 20 years ago.
All right, Richard, you're kind of our concluding panelist here. You helped start us.
Well, yeah, I'd like to say that in our 100-year history, we've largely followed the capital markets. So naturally, where the areas of growth are expected in the coming years, you're going to find Moody's, and that'll be a lot in Asia and Middle East and Sub-Saharan Africa, where we've already have our most rapid expansion to date. I mean, there are some open questions about the degree to which some of the Asian markets are going to be open to the types of finance that we're accustomed to in Europe and in the United States, and particularly in our business, where we're in the opinion business. There are some parts of the world that are not as open to the expression of opinion and don't necessarily want the product that we may have. They may or may not. They're in a decision process. So for us, there's a question about where we will be participating and in what degree, depending on how public policy evolves over time.
Well, thank you. And I want to thank all of our panelists this morning. And I want to, once again, challenge our audience, whether you're watching us on the web or in person with us today, that what you do in the area of finance does make quite a difference, and creating structures that help a country grow, educated citizens, build infrastructure is one of the important roles of a person in the investment business. Thank you very much.
Thank you, Mike.